Good evening, folks. Welcome to Quantsapp. This is Vicky Sajnani here, and today we are going to be discussing about option Greeks and option trading, essentially one day before the expiry. So let's start right away. Before understanding option Greeks, one is essentially wants to know the pricing of options. And how does the Greeks evolve? So the pricing of options is dependent on variety of variables that are fed into the pricing model to give the ideal option price. These variables include time to expiration, volatility, interest rate, underlying price, strike price. So these are the variety of variables which go in to, you can say, a black box, and out comes the ideal price of the option. So clearly, I mean, there are a variety of models out there. There is Black-Scholes option pricing model. Then for forex, in fact, we have the Garman-Colhagen model. So there is variety of models there for option pricing. But for the equity, in essence, in the equity markets, much of the famous model is the Black-Scholes option pricing model. So clearly, I mean, that gives you a perspective that how the things evolve. And moving on, the Greeks are a derivation of the option pricing model, and each Greek, and mind you, each Greek represents a sensitivity to the option pricing. Option Greeks are financial measures of the sensitivity of an option price to its underlying, determining parameters such as volatility, price of the underlying asset, or for that matter, time decay. All those words you must have heard. So that's what gives a perspective here. Right in the middle of the icon is the delta. So we shall be discussing in a very phased manner how each variable and each Greek influences prices of options, and hence which strike price is more suitable, or whatever the case may be, how to go about looking at. Is the Greek influences prices of options. Strike price is more suitable, or whatever the case may be, how to go about looking at. After this. No? Folks, sorry for the interruption. We can start off with the Greeks. The Greeks, delta is essentially the change in option value relative to the change in the price of the underlying security. Change in price of the option with respect to the change in price of the underlying asset. That is what is delta. Why do we need to understand delta? Is essentially because options are a non-linear product. Being a non-linear product, compared to futures, futures just has a delta of 1, which means if Reliance were to jump in by 1%, the futures would also go up by 1%. So that's the perspective. But in case of options, what we have is a non-linear product, hence the need to study delta and the various other Greeks. Theta is change of the option price value due to the passage of time. So as the time goes by, we know all these are time-bound instruments. So there is an expiry date attached to this. That's why we are here to discuss about expiry effects. So theta is the change in price of the option depending on the change in time. So that's what is essentially theta. Now moving on, vega. Vega is the change of the option price relative to the change in the volatility of the underlying. So vega is the change in the price of the option divided by the change in volatility of the underlying. So this essentially maps the volatility variation and how the option price changes with respect to that volatility. Okay, so that's easy to remember. V for Vega, V for Vicky, and of course, more importantly, V for volatility. So that's how you can link it together. Gamma is the change of the delta depending on change of the underlying asset. So this is what it is. Change of the underlying asset, change in price of the underlying asset, and we have change in delta of the option. That's what is gamma. And gamma is important to understand because gamma tends to explode upon expiry. So that's the reason why we need to ought to actually study gamma also. So let's now move on to delta. Delta is a statistical approximation of the likelihood of an option expiring in the money. So an option of zero point 0.8 delta has 80% chance of being in the money as per this definition. What we are trying to say is that an ITM option, an in the money option, and when there is only just one day to expiry, there's not going to be large, very large swings. So therefore, the probability of that ITM option to expire in the money is very high. Therefore, the delta of that ITM option will be higher compared to an OTM option. OTM option is likely to die out in out of the money. So the probability of that to come in the money is very low. Hence, that's why there's a higher chance for ITM option to be remain in the money. Therefore, ITM options have a higher delta. Similarly, an ATM option close to expiry has close to 50% chance of expiring in the money. So there's a probability it will either go up, the stock might go up or go down. So there's a 50% chance. Hence, it's called a point 0.5 delta option. Now, moving on, a bit of dynamics, a bit of complications as we move ahead. Okay. Now, consider the strike price of 16,500. That's the ATM option as of today. And what we are seeing is point 0.5, close to point 0.5 is the ATM delta, as I pointed out. Okay. And what we see is that 21st July expiry, the ATM delta is 0.49 for call option, and that is zero point 0.5 for 28th July, and 4th August also it's zero point 0.5. Now the blue shaded area are in the money options for the calls and for the puts. Puts are put on the left hand side, calls are put on the right hand side. So therefore, now what we are realizing is that a 16300 call, which is in the money as of today, has a delta of approximately 0.94. But a 4th August 16300 strike price call option has a delta of 0.66. Why is that so? Well, you ought to understand that a 4th August 16300 delta, 16300 strike price option is 0.66 because the probability of that coming in the money, there's a little while from now. There's a little while, there's a lot of time left. So there could be volatilities, there could be swings. Hence, the delta of an ATN option actually increases as time collapses. So in the money option of a strike 1600, we are seeing is 0.66, 0.71, 0.94. So for a 1 DTE, days to expiry, you actually have 0.94 as the delta. Similarly, if you notice, that's what is valid for even the puts. Except for the negative sign, you'll see a similar behavior in the puts also. 16700 is a in the money put, right to sell at 16700 when the market is quoting at 16500. Therefore, the delta of that with the days to expiry, one is 0.94 minus 0.94, which is stated here. And if you notice, the 4th August is minus 0.65. So clearly, I mean, we are seeing a rise in delta as the time collapses. As the time collapses, a rise in delta of in the money options. Similarly, there should be a collapse in delta for out of the money options, and that's what we are seeing here. 16700 call was 0, could be 0.35 delta on 4th August, But the probability of that to be in the money now, just one day from now, is limited. Therefore, the delta is 0.06. So clearly, what we see is that volatility, assuming volatility is 15%, we observe that the OTM delta decays as DTE decreases, while ITM delta increases as DTE decreases. So time to expiry actually causes this variation. That's what we need to understand, that the out of the money delta is actually going down, while in the money delta is actually moving up as depending on the time, other factors kept same. Similarly, implied volatility or the volatility impact on the delta. Now consider a nuance that if the volatility is 15%, we are observing a 16,300 call at 0.94 with one day to expiry. Now suppose the volatility was very high, say 50%. So the fluctuations become larger in essence. That is what is it's saying. So the probability of that to be remain in the money, to remain in the money will naturally drop. That's why we are seeing a 0.68 for a 16,300 call. Of course, at the money it remains the same. It roughly remains at zero point 0.5. So that's what we are noticing. Now again, in out of the money options, the volatility, because of the swings being large, the probability of the out of the money option to become in the money is slightly better off. Slightly better off. So 50% 16,700 call, 15% volatility is 0.06, 50% volatility is 0.32, because a higher volatility means there will be large fluctuations. So there is a possibility that it might come to 16,700 and then it could come in the money. So that's what it's trying to highlight to you. The probability that an option could come in the money based on volatility, swings. So we observe ATM delta isn't affected much by volatility. ITM options delta actually decreases as volatility increases, and OTM delta increases as volatility increases. Moving on, theta. Now, of course, long call has a negative impact of theta because as you are buying a call, theta decay happens. So that will hit your long call if it is out of the money, and then naturally, I mean, you'll have a time value of money which is going away. So naturally, I mean, clearly, I mean, a call option which is quoting at about $10, for example, would quote it around zero on the day of expiry, close to zero if it's expiring out of the money. So similarly, short call is a positive delta because you're shorting. So that's a negative nuance, and negative into negative is positive. So you have a positive impact of theta. You're gaining theta by shorting a call or shorting a put. So that's what you shorting options is a positive theta impact. That's what this slide highlights to you. So theta is a friendly Greek to option sellers. Higher volatility leads to higher time value and higher theta. The fall in premium due to time value is not a constant. Obviously, it won't be a constant. A day to day basis, the theta value varies. And the rise in theta decay heads maximum towards the expiry. Close to the expiry, you have theta values also moving up. So you have which hits you on a long position of options. ATM theta is higher than OTM or ITM thetas as DTE decreases. Decrease time DTE is days to expiry. So as the time decreases, you have ATM theta decay, which is higher than the OTM and ITM thetas. So these are the characteristics which one needs to keep at the back of the head before moving ahead for any of the trades. In case of gamma, in the money and out of the money, we shall see that why this is, but then they have amount of gamma exposure at delta, right? That's what we had discussed is the second order derivative, and gamma becomes very active close to expiry. So the delta, ATM delta varies a lot or explodes close to expiry. You'll have gamma exploding, so delta also moving up. So that's what we are trying to highlight here. So obviously, if you're a long call, then the gamma is a positive number. If you're short on a call, then the gamma will be negative number. Now gamma wakes up at expiry. Let's see that. So we move to the home page again, and just to pause a little here and look at the questions which, if any, are there. No questions as of now. If you're enjoying the session, please put a thumbs up, and that we would be grateful for that. And for a 2 days free trial of Quantsapp Pro, you can use the promo code YTube. So that's essentially help you in learning about options and understanding the Greeks and understanding the variations of open interest and other data related parameters and how option prices are influenced by them. So that's basically the tool, essentially the best data analytics tool in India is what is Quantsapp. So that's what. Let's move on. Option calculator, which is the app tool here, clearly a data analytics tool. Now we were so gamma is 16. And let's say the volatility. Let's in the money option for call options. So we go in for a 16,300 and we go in and calculate that. So you get the gamma which is lower, 0.008 clearly. I mean now we shall move on to an out of the money option for call. Let's say 16,700 and we calculate 0.011, 0.0011 again lower. So now let's revisit the 16,500. 0.0031 is the gamma. Now let's flip the expiries to 28 July and check out the gamma. It's 0.0011. Clearly, I mean, as I said to you, that the gamma wakes up on expiry, and the gamma for the as days go by, the gamma explodes. So that's what causes delta also to rapidly change. So that's a nuance which you ought to remember for this essentially for this example as such. Now talking about, I'll just pause for a second because I'll just have a look at the questions, if any. Moving on to the Nifty chart here, which indicates multiple indicators, the RSI, and this is the price chart essentially with volumes. And then you have the buyer initiated quantity and the seller initiated quantity. Clearly, I mean, on the expiry, I can just take an example of 14th of uh, 14. So we'll zoom in on the 14th expiry. What happened? I mean, you notice what you can notice is that clearly, I mean, there is a move. What we need to track is post 1 o'clock, because that's post 1:30 when the gamma wakes up. So that's when the gamma is going to wake up, and we can consider a straddle position there, or if you're taking a option long, preferred option long. So we don't suggest writing of options post 132. So that's a nuance which we understand from this, and essentially what we see is that clearly, I mean, a move on the lower side So one could have bought the call option, a put option in this case, or a straddle in the sense, and then one notices that there is an appropriate stop loss which ought to be maintained, which is close to 20% or the 30% of the premium. So if you're long option at 100, for example, then you ought to keep an stop loss 30% lower, which is 70 rupees. That's the stop loss which you would carry on a notional basis. I'm just talking. So that's a perspective which you carry. uh, what we are seeing is that the price move is on the lower side, so you can consider, before that we could have seen that there is an immense amount of sell pressure coming in from the seller initiated quantity, the red line here on the lower side, which is the order flow data. In order and trade book, which Quantsapp has, which clearly indicates what is the order flow, real time basis, not just the best five traders which are there out there, which is visible on the window of an Odin terminal or Omnisys terminal or anything of that sort. But what we try to tell you is that there is an order flow which is available here. So the entire order flow data, the entire order book can be studied here to a certain degree. So seller initiated quantity is marked in red, and the buyer initiated quantity is marked in blue. So clearly, I mean, you're seeing spikes of red being larger than blue. I have mapped both the graphs on one panel with one scale as such on the right hand side. So that enables us to read it carefully. So clearly, I mean, the red is reigning supreme initially. So that's what at 2 o'clock you can study these parameters as to how the behavior has been of the price action, and clearly, I mean, you can go long puts at this juncture with the appropriate stop loss. You can always consult your financial advisor also. We don't say, we are giving you perspectives on how to go about trading, but then clearly, I mean, you ought to understand that you ought to interact with your financial advisor, and please maintain a stop loss which is imperative or important in some sense. So clearly, I mean, later on you can couple it with RSI, and RSI showed a failure swing at about 1420, slightly later than that, and that failure swing confirmed at around 240 to 250. So clearly, I mean, at 1 o'clock you could have taken a trade for a small sizable bet of say about from yeah. So here, which was 16,000 to about, you could have captured till about 15,900. So about 100 points move in the put. So that's clearly, I mean, what you get. And please, at that time, you ought to participate in the ATM delta, because that's the largest delta which you have in some sense. Depending on the gamma is the highest there. So the delta jump which you would get due to the gamma is highest at the ATM option. So that's what you ought to understand here at this zone. So clearly, I mean, that's a perspective which you need to carry, and Greeks help you in understanding how to do a data dependent trade rather than just moving ahead with some notional gut feel as such. Moving ahead, you could also, what you could do is change the time scale to about 30 minutes, and you could observe the data. And if the first two candles and their range is large tomorrow with a gap down opening or a gap up opening, that range can be mapped on, and that should be a sizable range. So that range can be mapped on, and you can build a short straddle on the at around 10:30, at around 10:30 approximately. So you ought to understand that up till about 10ish, you ought to monitor the range, and after that you can go ahead and short the options. Let's see what the open interest picture is showing us. Open interest picture is showing us that 16600 call option is having one of the highest OI. So that could be the resistance point for you in some sense. And if you could see 16,500 and 16,400 are the next major supports. So clearly, I mean, an understanding of that is important to you for your range trading as such. Moving on. So once you have a range established, which is about, say, for example, if it opens at around 16,500, 16,300 tomorrow, for example, and it moves till about 16,500, so that 200 point range is the range which you want to map. And then you ought to no sooner the prices move beyond that, because that's your resistance and support established during the day, early morning of the day. So that's there. And you what you do is you write a straddle or a strangle, depending on your risk appetite, because straddle is more riskier and strangle is a little less risky. And then you move ahead during the day till about 1:30. So, and obviously, you maintain a stop loss of about 30%. So that's a combined premium which you get. Say, for example, you get a combined premium of 100, which we can see going to the option chain. I'll just move to the option chain for a second. So if we were to just look at the option data, depending on the closing prices, you can see 60 to 50 and 50. So thereabouts of 100 rupees, you can assume, is going to be the straddle combined premium 100 rupees. So clearly, I mean, you are safe till about 16,400 and 16,600, assuming that at that juncture it's at 16,500. So we are assuming there are certain assumptions attached. So at 16,500, you can, if you are shorting a straddle, there is a 100 point range which you're safe in. And you, what you pocket is the theta. What is theta value here? Theta value is approximately 27.9. And you can do a what if analysis, which I won't be doing right now. But then you can also estimate what the theta will be at a particular point in time in the future. So that's another perspective which you can carry with you. And of course, these are zero point 0.5 deltas at the ATM, whatever the ATM is at that current market price at that juncture when you're showing the option. And of course, mind you, for the first up till 10, you ought to monitor how the markets are. So you don't jump in the morning and just establish a trade. You pause for a little while till about 10 and then go ahead and go in for the strategy. So that's the perspective which we are carrying for the buyer initiated and seller initiated quantity. जो है buyer initiated quantity or seller initiated quantity chart, we have multiple videos out there which you can look through, and how we can go about mapping this on the chart. This is available in the Pro Plus feature, of course. You have to understand that. Again, वन पर्सपेक्टिव टू कैरी, एक सोच जो अपने पास होनी चाहिए कि भाई डेटा ड्रिवन ट्रेडिंग करना है, नहीं कि एनी आर्बिट्ररी ट्रेड करना है या कुछ गट फील आ गया उसके ऊपर ट्रेड किया. We understood today that how delta behaves with respect to volatility. We understood how delta behaves with respect to theta decay. Theta decay close to expiry is how much. Theta decay away from expiry is slower. तो अगर अगर आप लॉन्ग ऑप्शन कर रहे हैं तो थीटा इज वर्किंग अगेंस्ट यू, गामा इज इन फेवर ऑफ यू. सो यू हैव टू अंडरस्टैंड दीज पैरामीटर्स, और ये चीज आपको ध्यान में रखना है. एंड उसके बाद ट्रेड करना है. So that is one important aspect to understand when you are trading the markets as such. See, in the open interest tool, जो option chain tool है, उसमें राइट हैंड साइड और लेफ्ट हैंड साइड पर ये बार्स जो दिख रहे हैं वो ओपन इंटरेस्ट बार्स है. बेसिकली दैट इज आल्सो गिविंग यू अ पर्सपेक्टिव दैट व्हाट द ओपन इंटरेस्ट इज एट द वेरियस स्ट्राइक्स. क्या क्या स्ट्राइक्स पे क्या क्या ओपन इंटरेस्ट है वो समझ में आ रहा है आपको इससे. So that's that. And let me look at some questions, if any. before we wrap up the session, that's all from my side. And let's move on. If you like the session, please use the app also and try to do some learning and awareness of the tools is important for us to do a data driven trade rather than doing some randomized trade out there. So that's of importance to us. And this is the QR code which you can scan. I'll pause here for a second and give us reviews as to what essentially can be done and how we can improve और कैसे बेहतर किया जा सकता है वो वो चीज़ के लिए आई बेसिकली पॉज हियर फॉर अ सेकंड थैंक यू and wish you happy trading during the expiry